Why are Chinese stocks all of a sudden getting absolutely destroyed, even though just about 2 months ago we predicted these to have potentially already bottomed, well ahead of the S&P 500 in the US? Well, in this video, I want to address some of the recent drama we're seeing around Alibaba, Xpeng Motors, and Nio to understand why we're starting to see this very aggressive selling in Chinese equities. And at the end, I also want to analyze the latest delivery numbers for July from the Chinese EV automakers to understand whether or not there's still growth left in these companies for at least the next 3 years, which should warrant a very attractive investment opportunity right now. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So the first thing I want to address is why exactly have we seen all this fear and drama on Chinese equities? Well, the simple reason for that is because Jack Ma was just recently forced to give up one of his controlling positions in Ant Group. This obviously comes after some of the executives from that company had to step down. And why is Ant Group an important aspect in the Chinese stock world? Well, because Alibaba owns a 33% stake in that software company. Now, in my opinion, from a long-term perspective, as somebody's investing in equities in China, here in the US, I don't think this will have a major effect on the business of Alibaba. Primarily because Jack Ma has already stated that he's trying to separate himself from the Chinese government, because obviously he's been very critical of the operations in China. And I'm not saying that China is a perfect country. There's a lot of risks in investing in China. But the idea here is that in the US at least, we need to understand how much of those risks have already been priced into the company or the stock that you're buying, right? We already saw that with the US, right? A lot of people have been surprised that the S&P 500 has been rallying for the past couple of weeks, even though we've gotten all this bad data about recession and inflation and whatnot. Well, this is exactly the same situation we could experience with Chinese equities as well, because at some point, the market's going to stop reacting to all the bad news. And that's when we're going to realize we're going to be close to a bottom, and stocks are going to start recovering to their intrinsic value. And one of the reasons why China could be much closer to that bottom than many people expect is because of the fact that the inflation rate in China has already peaked in the middle of 2021. What this essentially tells us is that China is already ahead of the US when it comes to its economic strategy. And what do I mean by that? Well, simply because China was much more aggressive with the recovery out of the pandemic in 2020. And because of that, their inflation rate skyrocketed. And as a result, China had to cut or increase interest rates. And because of that, they put themselves in a recession. And because of the fact that their population is so dense and there's so much movement in and around Chinese cities because of their exports and imports, China had to implement a COVID-0 policy, which obviously took effect in March, April, and May of this year and caused a little bit more of a supply chain problem. And that's something obviously we got priced into the stocks like Alibaba and Xpeng Motors. But the key idea here is that inflation in China is going to stay relatively stable unless we see maybe another year-long lockdown, which is chances of happening is pretty rare because of the fact that many people are already vaccinated. And obviously following that, we also know that right now, a lot of companies in the Chinese indexes are simply trading much cheaper than the S&P 500. A simple reason for that is obviously because there's a lot of risk investing in China, but this could be creating an opportunity for those people that are looking for good risk-to-reward investments. You can see that in the past, because the Chinese economy tends to grow at a faster rate than the US economy, historically, the red line has always stayed above the black line. But right now, we're experiencing a complete flip. And it's up to you to decide as an investor whether or not this is creating an opportunity, or is this just another form of fear-mongering. For me, this is creating an opportunity because historically, we've seen these very fearful times multiple times in the past for China. And this is no different right now, except that we're coming off an even bigger high in 2020. And so from a risk-to-reward perspective, I like Chinese equities here. Even though, yes, there's a lot of risks in investing in China. There's a lot of people there's a lot of companies that could get delisted here in the US. But the good thing is that a lot of that share ownership can be transferred over to mainland China. And a big reason for that is because just recently Alibaba came out and granted its listing to the Hong Kong Stock Connect scheme. This is a pretty big deal because this is going to allow mainland China investors to buy Alibaba stock, the same stock that we're buying, but on the HK exchange. And that is obviously pretty big because the Chinese consumer are the main folks that interact with the Alibaba business in the e-commerce world. So it's a pretty big deal if those same people can now own the company. and that could create a lot more demand for the equity and also allow Alibaba to hire a lot more talent, which obviously can fuel their competitive advantage and drive growth for the business. As for answering the question, have Chinese equities actually bottomed and this recent sell-off is just another fear-mongering tactic? Well, to answer that question, we need to look back in the history of how stocks typically tend to bottom. And the way I'm going to look at that is from the 1990 bear market on the S&P 500 in the US. As you can see, typically when stocks bottom, we follow this very aggressive capitulation pattern for a few months, followed by a bounce, which seems like the bottom, but then another capitulation to the downside, which tends to make a lower low from the previous low. And then you can see we just seem to see a lot of sideways action for a few months, chop around, kind of basically shake out all the weak hands, and then rally. And then at the very end stages of those rallies, we tend to see another capitulation, which essentially looks like that this is just a bear market rally and that we have not actually bottomed and everybody got faked out and everybody's now shorting. And it's typically after those ending capitulation rallies is when the market actually bottoms, right? It's just another way to shake out all the longs and shorts that were buying up here and then shorting down here. And as you can see on Alibaba, which is essentially the biggest company in China, we're following a very similar pattern to that. We saw this capitulation happen in Feb and March. We saw a nice rally. Then we saw another capitulation in April. And then we've been seeing this very sideways action for like 3 months now, right? And then like I was saying, we saw that nice little rally. And then now we're experiencing that late stage capitulation, which essentially reflects this action right here. And chances are we could be seeing this actually confirm the bottom and not these bottoms right here. Now, obviously, there's a lot of risks, so we don't know if this is for true. But in my opinion, this is creating a nice and attractive opportunity if you're trying to invest in Chinese equities. As for which is my favorite Chinese EV stock, well, the answer is pretty clear. It is going to be Xpeng Motors. Not only because this company is growing at a significantly faster rate than most of the other Chinese EV companies like Li Auto or Nio, but also because the valuation for the stock is actually significantly cheaper than those exact same stocks at a price of sales of only 4.13. And as you can see, in 2022, they're expected to do revenues of around $6.06 billion USD, which will obviously cut that price to sales ratio in half to almost 2. And in my opinion, that is simply way too cheap for a company that is innovating at such a high level. And as for what I mean by that innovation, well, as you can see, Xpeng is launching their all-new smart SUV, which is going to be their first entry into the mid-size luxury market in China and in Europe. This vehicle is expected to actually be announced and launched for a pre-order run on August 10th, which is obviously this Wednesday. This is going to be a pretty big catalyst for the stock, and it's going to give us a very good understanding of the demand for this vehicle in the future, because obviously the Chinese economy is now only recovering from a recession. And because of that, interest rates are being cut, and the demand for vehicles is going to increase. Now, even though in the short term we're starting to see these articles where people are saying July was a very poor month for Chinese EV stocks, and that's certainly a reason for why the stocks have underperformed. Simple matter of the fact is that summertime is always typically very slow in China, and we all know that EVs are a cyclical industry and they change by the seasons. Typically Q3 and Q4 are the strongest times for delivery numbers, and that is when I expect somebody like Xpeng Motors, Li Auto, or even Nio to outperform the rest of the market. As for now, as long as these stocks are down, and they are down very much relative to the S&P 500, I will continue to be a buyer because I have significant conviction in these companies being very good growth plays, even though there's a lot of fear investing in China right now, which, as I've just showed you, is completely unnecessary. But as usual, guys, make sure to drop me a thumbs up and hit the subscribe button if you haven't already, and I'll catch you guys in the next one. Take care.